Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello and welcome to Business Line State of Economy podcast. I'm Lokeshwarri. We are very pleased to have with us today Achala Jethmalani, Economist, RBL Bank. We'll be discussing all about global interest rates, bond yields, global growth outlook, dollar, rupee, and much more in this podcast. Let's begin with the global growth outlook for 2024. We know that the interest rate cycle seems to have come to an end almost, with most global central banks hinting that the rate hikes are over. So do you think that a soft landing has been achieved, or do you think there's more pain ahead for the global growth as such?
Thank you, Lokeshwarri, for the question. As you rightly mentioned, in the last 1 year, 2023 will be really defined as the year where we will probably see the advanced economies policy rates peaking out. And as we kickstart the new year with 2024, we will see that the central bankers will actually start moving lower on their policy rates. The question and what would be of interest this time around would be, when will the rate cut cycle begin, and what will be the pace of rate cuts? Would it be as sharp and steep like the rate hikes, or is it going to be a gradual one? So, based on our assessment, and also when we look at the IMF World Economic Outlook projections for advanced economies and the world growth being pegged at about 3% for 2024, with US being at 2.1%, and then it moving to 1.5% kind of levels, the expectation is that the US would see a soft landing. And as a result, given that inflation is gradually moving towards its 2% policy goal target, and the employment situation and the labor market starts to cool off in the States, by June 2024, we will see the narrative change to rate cuts, and the first rate cut is likely to be delivered in the June monetary policy by the US Fed, is what we are factoring in. Now, when we look at the Davos 2024 event that is ongoing, in that also we've seen that the policymakers remain quite data dependent. And the word that has been used repeatedly by policymakers and central bankers, it is that of the prevailing uncertainty, the geopolitical tensions, as well as climate conditions. Now, in the backdrop of such uncertainty, we think that the pace of rate cuts would probably be much slower than what was the pace of rate hikes. So that's where we stand when we look at the overall global scenario in terms of growth and policy narrative.
Okay, that's very well explained. So what are the risks actually to this growth expectations, projections that you're giving? And do you see inflation actually spiking higher sometime? Is there a risk of that happening?
Okay, so in terms of growth, I think the key risks that could materialize would be if the geopolitical tensions were to persist, especially with the geoeconomic fragmentation being one part of it, and second being the ongoing affairs in terms of the Red Sea logistical aspect. So that could be a headwind to both higher inflation, because supply chain bottlenecks could return, and second could be a lower growth because exports would take a hit for exporting countries, so global growth could face a downturn. And also, in terms of consumption, the consumption could also take a hit, given that the ships have been rerouted through a longer route, which takes a higher toll in terms of both expenses as well as for goods getting delivered. So that remains a headwind if that problem was to persist. And of course, for a country like India, it would transpire by way of, say, higher commodity prices, in particular crude oil prices. although we are seeing it remain fairly stable in the range of 77 to $80 per barrel. But therefore, that we are saying that that is one event that one needs to watch out for in the ensuing weeks and months. Second is, of course, 2024 is when we will see a lot of countries going into election phase, especially the world's biggest democracies, that being of the US and India as well. So while Taiwan elections are behind us, there is overall 40% of world's population that will be voting in 2024. So that is something that could probably be an event risk in the year 2024. It may have a positive impact since it's an election year. We could see some bit of growth leg up, but also what will be important to watch out for is whether it would translate into fiscal profligacy or whether fiscal prudence would prevail across these economies. So far, the narrative, even at Davos, remains that of remaining in the phase and on the path of gradual fiscal consolidation, especially post pandemic. So, these are a couple of headwinds that we will be watching out for in 2024. But as of now, risks remain fairly balanced. When we look at the overall growth and inflation scenario, we don't see such major black swan events that could probably push up inflation dramatically higher in the ensuing quarters.
So, against this background, how do you see the US dollar moving? Because we saw it softening a little bit, falling a little, but how do you think it will move over this year? And what will be the impact of this on the Indian rupee?
Yes, that's again a very good question. We did see that the dollar strength was starting to dissipate, and in anticipation that the Fed rate cut cycle would begin as early as March. But when we are looking at comments and also when we're looking at the overall inflation and employment data coming through, the rate cut expectations have been pushed ahead. When we also look at the other continent, when we look at the Eurozone and when we look at the UK inflation numbers as well, they're also slightly on the higher side, which also mean that it is only during summer, which is again in during June and after June, where we could see the rate cut expectations come through for the euro area as well. So as a result, we are really seeing that the dollar has gained some more momentum. At present, it is about 103 and a half kind of levels. And if at all there was not a soft landing, but there was a major growth concern, then we could see that risk assets may not be favorable, and therefore we could see the dollar index would strengthen again. But at this point in time, we are really working with the range of 100 to 103. That's where we see that the dollar index would be in that particular band. And in terms of impact on Indian rupee, I think Indian rupee has been fairly steady, and also with external sector fundamentals favoring India and the robust capital inflows that we have seen over the past few months, in particular post September 2023, when the bond inclusion news was announced, we've seen that the country has actually received dollar flows, and overall it has favored the currency, and there has been a lesser depreciation bias on the currency per se. We are seeing that there is an improvement on the trade deficit front as well. We saw that the monthly run rate was much higher than about 20-22 billion dollar, with October touching an all-time high of $31 billion, and now the last print it has come down to about 19.8 billion. So there is this positive tilt that we are seeing for the currency, but overall we still think that it will be fairly in a tight range of about 82 to 84 a dollar. Reason being because we also head into election during April May, so we could see that there could be some bit of stickiness in flows, and FDI flows may come through only post election season is behind us, and by the time we reach the end of this year, there will be US that will be heading into election. So we could see that the capital flows may dry up somewhat, and therefore the sharp appreciation bias may not really come through. So 82 to 84 and dollar index being around 100 to 103 is where we think the momentum is more likely to be.
So, talking about flows, do you see significant flows coming in due to this bond index inclusion? Because we had this JP Morgan including Indian bonds in the index, and now we had the Bloomberg also doing it. So, would that make a significant impact on the flows?
If we look at the flows data from September 22, when the bond inclusion news did break out officially, we have seen that the inflows in the debt market are a little shy of $10 billion. So we were anticipating that we could see an annual inflow of about 25 to $30 billion over a period of time, but of that, 10 billion is already in. And then the recent announcement that Bloomberg is also considering in the EM bond index, although the asset under management, when we look at that particular indices, is relatively smaller. So we may not see a significant bump up, but in terms of momentum, it is a definite positive. So overall, yes, I think we could see capital inflows in the debt market actually pick up in the ensuing months once the bond inclusion actually kickstarts from June 2024. I think a lot of these asset companies have already piled up as it is getting reflected in our debt market numbers. So in the same period, in equities, we saw inflow of about 6.2 billion from about say 22nd September till 15 Jan, and even in the debt market space, it is as much. So it has happened after a very long period of time that we are seeing debt market garner so much interest. So I think the sentiment remains quite upbeat for debt market per se.
Okay, so Achala, we have the union budget or the interim budget around the corner. And one number we'll all be watching is the borrowing figures for the central government. So, what is it that you are penciling in terms of the market borrowing that will be happening, that they'll be targeting? And is there a capacity to absorb all these extra papers that will be issued?
Yes, that's correct. So this will be a vote on account interim budget, as you rightly mentioned. But I think this would still be important because markets and analysts would be watching out for the government's fiscal consolidation roadmap, whether it would be cutting back on its fiscal deficit to GDP ratio by about 50 basis points or more. So as of now, we are working with the base case of it lowering its fiscal deficit to GDP ratio from 5.9% to 5.5% in FY25, which in as per our estimates is translating into a fiscal deficit of about 18 lakh crore. And if we were to take an assumption that say about 65 to 66% of it gets translated into net borrowing figure, then that would mean that we will be at around 11.5 to 11.9 lakh crore kind of a net borrowing figure. And gross borrowing could be relatively flattish at 15.2 to 15.6 lakh crore. So in FY24, gross borrowing figure was about 15.4 lakh crore. So this time it will be around similar levels. You can say it will be largely flattish. And net borrowing figure could be slightly higher because this time around the overall redemption burden is lesser at 3.7 lakh crore. Last year we saw that the redemption amount itself was about 4.4 lakh crore. So in that sense, I think bond markets are relatively prepared for a net borrowing figure of about 11 and a half to say 12 lakh crore. And in terms of gross borrowing, also as I mentioned, it is largely looking it to be in the range of about 15.2 to 15.6 lakh crore. So in terms of absorption, I think yes, it is likely to be absorbed fully by the markets without any detrimental impact on bond yields as such. One of the reasons being because we think that there could be a fresh demand that we could see come through in the form of FPI inflows. We have seen some leg up in that segment already. For example, the data till September 2023 actually shows that the ownership of FPIs of GSECs has actually gone up to say 1.6% versus about 1.3% seen 4 quarters ago. So we are already seeing that the ownership pattern is kind of changing, and with insurance companies also continuing to mop up, and the government has been focusing on issuing longer dated bonds, which again leads to it getting absorbed by insurance companies. So we are fairly optimistic that it overall for debt market and rates market, 2024 is likely to be a good year, both in terms of supply being largely subdued and muted. A positive surprise would be a definite welcome if government was to take a faster fiscal consolidation roadmap. And second would be due to positive developments such as the bond indices inclusion, where we are seeing FPI interests come through. So overall, quite positive on the debt market space. Overall, we are saying that the net borrowing figure would be about 11.2 to 11.9 lakh crore, and we are quite positive that the supply demand dynamics favor the overall bond yield environment in 2024 and FY25 overall.
Okay, so that brings us to the last question. What is your view on the GSEC yields going ahead for this coming year, 2024, for this year, that is?
Okay, so as of now, if you look at the current 10-year bond yield, it is at about 7.16 level, and basis our understanding and assessment of the fiscal deficit roadmap, and also policy rate expectations, which we think will be largely status quo at least till first half of calendar year 2024. In that backdrop, we are saying that the yield range for the 10-year could be about 6.9 to about 7.20. And any positive momentum in terms of, say, faster rate cuts globally and positive inflation outcomes back home. As of now, inflation prints have been on the higher side because of volatile food prices. And if at all in 2024 we could see food inflation come down, then chances of rate cuts coming through in second half of calendar year 2024 improve dramatically. And therefore, we are optimistic that from here the yields would be largely on marching lower, and therefore the range that we are working with is about 6.90 to 7.20 in 2024.
Thank you so much, Achala, for your views on everything, including the growth and inflation and dollar, etc. I'm sure our listeners benefited greatly from your views. Thanks once again.
Thank you, Lokeshwarri, for having me here. It was nice to interact with you.